Hello, this is Marie Lundi, your trusted real estate advisor. And so welcome to your December 2020 market update. And so being that it's the end of the year, we are in a great position to reflect on what took place in real estate in 2020 and also forecast what can be expected in the new year. And so for today, we will use graphs and data from economists and market experts to kind of get a look of what's up and coming in the new year in terms of real estate. And so let me go ahead and switch over to my screen so that we can take a look at the data as we're talking. And so looking at the real estate housing market for 2020, we see that at the beginning of 2020, we were heading towards a normal real estate spring market. And as we know, in early March, because of the coronavirus, the entire country shut down. And the real estate industry was equally impacted. So you could see graphically that the level of activity in the real estate industry dropped significantly between early March to May. And in early May, what took place is that the mortgage interest rates were dropped significantly. And as a result of that, any buyer who was remotely thinking about buying a house were compelled to jump back in the market despite the pandemic to take advantage of the low rates. And so you could see that between early May all the way through the remainder of 2020, the level of activity when it comes to real estate increased significantly. Okay, we're actually closing the year with stronger numbers than last year. And last year was also a strong real estate market. So what took place in 2020 to stimulate the economy is not only the low mortgage interest rate, but in addition to that, we had a low level of available properties on the market. So because we had a low supply of properties on the market and a high demand from buyers who were looking to take advantage of the low rate, the property values have gone up significantly over the past 5 to 6 months. Which begs the question, prices are going up so quickly. Is this a repeat of 2006 through 2008? Are we facing another real estate bubble, potentially another real estate crash? To that question, the chief economist at the National Association of Realtors is saying absolutely not. He is saying that there is no comparison between what took place in 2006 and today's real estate market. He goes on to say that back in 2006, because of the adjustable rate mortgages, which were a great financial impact to a lot of the homeowners, many homeowners were forced out of their home. They were forced to sell their home, right? Versus today, a number of the buyers and homeowners are in a conservative fixed rate 30-year mortgage. So paying their mortgage is less of a financial burden as so many people faced 14 years ago. In addition, the chief economist is saying that 14 years ago, there was a surplus of properties on the market, right? The market was flooded with inventory. Okay, upwards of close to 4 million homes were listed for sale 14 years ago. And builders were adding upwards of 2 million new homes on the market. Versus today, as I pointed out in the last slide, we actually have the reverse. We have a shortage of inventory. As of the past year, we only had 1.5 million homes on the market, and home builders are underproducing relative to the historical average. So if we look at the relationship between the level of inventory and home prices, and we take a look graphically what took place between 2010 and today, we see that 10 years ago, we could see the level of inventory on the market compared to what's available now in the market. So visually, you could see that the level of properties available to buyers is significantly much lower than it was, let's say, 10 years ago. It's a big difference. And the relationship between the level of inventory and price is as the number of available homes decline on the market, that actually drives prices to go up. And we could see that looking at the green line, right? So this is where we are today. High prices because of the low inventory. And so this graph illustrates what the chief economist was saying. Basically, that there is a smaller percentage of today's buyers or today's homeowners' disposable income going towards their mortgage payment. Versus if you look at the percentage of disposable income going towards mortgage payment, let's say 14, 15 years ago, it was almost double. And so looking ahead, looking at what's to come in 2021. And so, of course, no one has a crystal ball, and we cannot predict exactly what will take place in 2021. A lot of it hinges on the pandemic still and the vaccine around the pandemic and how quickly we are able to recover financially as a country, right? But a number of the economists are looking at today's interest rates. So if you look at the past 2 quarters of 2020, the mortgage interest rates were around 3%, slightly below 3%. And many of the leading economists are saying that those rates will remain, as you could see, around 3% into the new year. And so if that is the case, if we continue to have very attractive mortgage rates, and if the level of inventory remains around the same, if we're not flooded with new properties on the market, the estimation is that we will once again have a strong real estate market, a strong seller's market. But once again, that will depend on how many people are putting their homes on the market in the new year. If the new homes on the market are quickly absorbed by the buyers because of the low interest rates, then once again, the expectation is that we will continue to have a healthy real estate market. And so I hope that you find today's information helpful. And if you're thinking of buying or selling real estate in 2021 and you would like to discuss your unique situation further, please don't hesitate to contact me. Once again, this is Marie Lundi, here to help.